Tim, what are the three key reports you're watching? I don't know if we'd call them so much as a barometer, but just in the anticipation of some more big swings.
Yeah, I mean, I think we had the biggies this week, but if I look towards next week, the three earnings announcements that stand out to me are Peloton, Disney, and even Twitter. So if I think about Peloton, again, I don't think this is the economic bellwether of the world. I do think it's a poster child for the high multiple tech stocks, the COVID pull forward, some of the stay-at-home trends that I think have really deteriorated rapidly, but again, those comps that are very, very difficult. So Peloton is trading. You look at the charts, and this is not necessarily your valuation read, but it's trading pre-COVID levels. But more importantly, at this point, it's trading about 3 times 2023 connected fitness subs, which is very cheap for this company, and it doesn't even apply any value to the actual hardware itself. So to the extent that I think, look, they've guided to the market. They announced a week ago. They've pre-announced these numbers. I don't think there's going to be a lot of downside surprises, that demand has been cut back, that they've had to right-size production dramatically, that they're in cost-cutting mode. I mean, these are scary headlines for a growth stock, and I
Sure.
think obviously the stock priced that in.
Ty, the problem is that Tim claims he does not like riding a bike in his apartment. What is he missing as a user?
Yeah.
The user experience, Tim.
Get with the flow, Tim.
Well, Ty, it's clear that you obviously are cycling over time. So, I mean, we should all take a cue from you. But again, I'm not riding my bike in my apartment. So, that's the last thing I'm doing. But I do think this is an interesting story at this point. It's nothing to necessarily base market dynamics on, but I think it is an important read. This stock largely has put in a base over the last few days, if not few weeks. And let's see.
I want to save Disney for last, Tim, and skip ahead to Twitter if we can. This one has been a tough stock. I think it's down for the 5th month in a row, something to that extent. But as people were sifting through the social names this week, I did hear some positive sentiment on how Twitter could be better positioned than others for various reasons. What are you watching for in that report?
Yeah, full disclosure, I'm long Twitter. I'm addicted to the service. And I think it obviously was painted with both sides of the brush this week, both with Facebook, Meta, but then obviously a snapback by Snap and Pins and some of the stories. And I think, look, a unique digital platform, a company that I think actually has a bit of answering to do. It was about a year ago. They had a very, very bullish investor day where they talked about 315 million DAUs by next year. They talked about doubling revenues by next year. I don't think they're close anywhere there. And in fact, I think they brought a lot of both investors and the street offsides. And I think a lot of those estimates still need to come down, although a lot of it's been recalibrated. Twitter, not expensive by its own history. It's probably trading at 4 times next year's sales. And again, I think this is a case where these high multiple stocks, when you're not growing, you're going to get destroyed. But I think some of the existential risks around Twitter, I think, have been answered. I think the engagement's been improved. I think the ad growth is a very strong story. But it's been a major disappointment. And I think the engagement is still something that needs to be proven.
Absolutely.
How about the CEO?
I think we were hoping that this was going to be a dynamic change when, in fact, it's really more of trying to keep a dramatic change in the medium term. But, I think that was part of the disappointment. I think, Jack Dorsey stepping aside, the pressure, the activist pressure at some point was a really positive tailwind for investors, and it hasn't proven out here.